What's up, everybody? Today we have a very special guest, Mr. Gregory Crane. Gregory focuses on the slow flip method, and this is one of the niches of seller financing in real estate that is very interesting. The general principles look as follows. You find a livable house for under $50,000 anywhere in the country. You use private capital to buy the property. With that private capital, you're usually doing 5 years fully amortizing at 12% interest. And so for the first 5 years, you have the $50,000 property, you sell it for, say, $100,000 on seller financing, get a few $1,000s down. And then you're going to charge them about $1,100 per month of PITI. That money is going to be used to pay off your private lender. After 5 years, your private lender will be fully paid off. And now you have a fully paid off asset, and the family still owes you $85,000. And now you're just sitting there and you're cash flowing. You just collect that $1,000 per month. That is your money. That's true cash flow. And that's why they call it the slow flip. So the slow flip, the idea is that you're pushing off your benefits to the future, but you're building these assets that in 5 years are going to be really nice cash flowing assets. There are pros and cons of this model, and we go into it with Greg, who's now done 7 or 8 of these. We talk about a lot of the different questions and minutia that comes with this model. As you start to understand seller financing and wraparound mortgages, lease options, these different types of things, you start to see that this can be applied to so many different asset classes. And there's a huge power in how we structure these deals. So we're fortunate today to have Mr. Gregory Crane speak to us about his journey and experience as he's learning how to do this more continuously. He has a handful in his portfolio, which is amazing. And now he's looking to 10x that over the next several years. So stay tuned, listen in, and I hope you guys really enjoy this interview here because it is just another way to open your eyes to the different types of exit strategies there are, to have some light bulb moments to start to understand the different ways that you can structure all these pieces. So sit back, relax, enjoy this call, and let us know in the comments what you think. Please like and subscribe on YouTube, Spotify, so that you can get access to more of these interviews and more of these calls. Today, we are very blessed to be with Mr. Gregory Crane. Greg is a mortgage broker. He's a father. He's been in the real estate creative finance space for quite a while. I first met you talking about private money lending and doing money lending deals. Recently, you have done 7 or 8 slow flips. That's really what we're going to be diving into today, learning more about the slow flip model, how it's been for you, how you find your deals, and so on. Welcome to the call, Greg.
Thanks, man. I've definitely been inspired by the community you've been building. I love the content you're putting together. So it's honored that you asked me to come on and chat about this.
I have tons of questions about slow flips, but maybe first give us a little glimpse into how you came across this model and when you started doing it.
Yeah, so I've tried, like a lot of people, jumped around from thing to thing. As you mentioned, private lending, mobile home flips. I've done a few of those and some traditional fix and flips in Knoxville, Tennessee, where I live. Those are all good. They all have risks and challenges. The thing that has been eating at me over the last year and change has been all of these things, traditional flips, private lending. It's all very transactional. You can make a chunk of money if everything goes perfectly in 3 or 4 months, and you pocket that money and you put it into something else. Unless it doesn't go well, and then you're in a deal for 8 to 10 months, and maybe you're making less money, maybe you're losing money. And there was just that roller coaster, and kind of not why I wanted to get into real estate. I wanted to create a little bit more dependable monthly cash flow. And you being a rap person, I know that you can understand that. The way to do that is to come to bank. I mentioned two things that were sort of eating at me. The other was just the state of the economy and the unaffordability of everything. And so, that drove me from fix and flips and lending on flips to mobile homes, and now this slow flip model, which we'll talk about, because there's such a demand for affordable housing. There's financing is such a huge challenge towards people getting into home ownership. If there was a way to provide those financing options and create a great return, I was interested in doing that. So I actually started doing a mobile home model, was very similar to slow flipping, which is basically just buying for cash and selling on terms, which has been around for a very long time. I've done a couple of mobile home flips where I've exited with seller financing and using private money as that conduit to acquire, but also to have a partner who gets part of the monthly cash flow and allows you to exit on seller financing. A slow flip is basically just buying a property very cheap for cash or with the private money, and then wrapping that exit and that sale with seller financing via contract for deed or an agreement for deed to your end buyer. So if you start following YouTube group, Facebook groups and stuff, you get more and more, people trying to sell you stuff. I bought Scott Jelnick's free slow flip book, and he really spoke to this notion of trying to create financial freedom through setting up monthly cash flow. Even if it was $200 a month, if you could stack enough of these at 200 a month and eventually pay off your private lender, you would then have a portfolio of properties all paying, $700 or $800 a month. Right now, I'm using my IRA with JV partners. So I've only borrowed money on one deal. Definitely looking for more private lenders to be able to scale this, and also private money partners, people I can share in the cash flow with and create a win-win there.
Amazing. I just love the power of seller financing overall because, like you say, you did with mobile home parks. I have people doing it with land development. We do it with houses. So there's so many different ways to just leverage the strategy of putting in-house financing and doing some form of wraparound mortgage. I'd love to hear a few things because I know with the slow flips, you're looking at houses typically under $50,000 that are in livable condition. Is that accurate?
Yeah, that's exactly it. Where can you find homes like this? It's a lot of stuff through the Rust Belt and the Midwest,
Right.
primarily where I've been buying.
Where have you been finding your deals?
Through the investor communities that I'm in, and also on Investor Lift, through local Facebook off market deal groups and whatever city or state I'm looking at. But a lot of it has just been people who are wholesaling to our slow foot investor pool. So we know that they've been inspected. You should always have your own boots on the ground, do your own inspections, and not take anybody's word for it. And that's primarily how it's been. One of the things I'm looking for is consistent deal flow for homes that are not totally trashed. And one thing I'm playing with is, do I go in big cities and rougher areas, or do I stick to smaller cities? One of the homes I bought was in a city of 6,000 people. So we didn't get a ton of tenant buyer activity. And so we ended up just wholesaling that for, small profit and just kind of move on to the next deal.
Yeah, for sure. So you're finding them mostly just through Facebook groups, MLS.
Yeah, I would do a filter for 50,000 or less. I want to be 3 bedroom, over 1,000 square feet. The goal is to find something that a single mom with a couple of kids could move into. Looking for stuff that has longer days on market so that there's some negotiation power, which in this economy, there's a lot of that, because things are sitting and things are not moving.
For sure. And what do you define as livable? What are the main things you're looking for to classify a house as being livable?
Yeah. So no leaks in the roof, foundation. This is an asset. We sell them as is. We don't make any repairs to them, but it's still an asset that I'm investing in. So I don't want something that has water intrusion issues, foundation issues, that has a lot of, growth on it that can really damage a property. Ideally, they have appliances and bathrooms and kitchens. For instance, I just bought one in Flint. I was able to, because of the network that I have, get it filled within a week, which was really amazing. The carpets were a little gross. So I just paid to have the carpets clean because I wanted my tenant buyer to come into a house that was ready to go. So I had another house that was full of junk, and some of the floors were just the subfloor. So we cleaned it out. We had it bombed for bugs, debated putting on some LVP, but it's sold as is. Some people want to come in and make it their own and choose the floor coverings and things like that. Not a lot of holes in the walls. Appliances would be great. I have a mobile home I just sold recently. We did not put appliances in, and we didn't put an HVAC in because we spent so much money redoing the kitchen, redoing the floors, paint. It was a huge rehab, and that's still sold. So some people might want to make those choices themselves.
And you're doing this all virtually, so you're in multiple markets. So a few questions. One about the rehabs and one about the inspections. So when you're looking at a property, are you just finding an inspector, boots on the ground to go look at the properties for you?
Yeah. So through the community that I'm in, there's popular markets, Illinois, Greater St. Louis, Flint, Michigan. I've got a good team. And so I have boots on the ground. We just closed on one with a partner and looked at it, and it's just full of junk in pretty much every room. When you're evaluating a deal, you want to say, okay, this is going to be an extra 2 to 4 grand, because while we are selling them as is, we definitely want to clean them out so we have a blank canvas to advertise. Boots on the ground is really critical, and backup boots on the ground. I have one that I bought that had not been sold yet. It had a tenant, and we were going to try and convert him to a buyer. He offered not to. Before he moved out, he called to tell me that the house had been broken into. Some of these, because of the price point, are in rougher areas, and you're going to have to be selective about that. So I had my boots on the ground was out of town. I had went on Facebook, went to an investor group in that city, was able to find someone. Facebook is amazing. There's a lot of shady characters too, but and was able to find someone who was a handyman within a couple hours. And he went and changed the door because the lock had been pried off. We put some no trespassing signs in the window. And so, yeah, but that's definitely before you invest in any city. I would understand the economics of it. Is it a retracting city? Does it have growth potential? I feel like a Debbie Downer, but I certainly do feel like the economy is teetering a bit. And I think despite the record stock market, the next year could be a bit shaky. I'm trying to make sure that I'm in markets that have enough industry and enough draw that they will be able to be resilient.
Amazing. Out of your 7 or 8 deals, how many were from the MLS? How many were from wholesalers?
A couple were for Investor Lift. Investor Lift is a great deal source. I don't think anything was on the MLS, and the wholesaler might have got it under contract through the MLS and then assigned it. Most of the time, it's through wholesalers, and I'm happy to pay assignment fees for a good deal.
Amazing. And then what do typical numbers look like for you?
Lately, I've just been using my IRA account with a JV partner. I go on title and we have a JV agreement that says we're splitting the investment and the profit. The resale price is typically 700 to 900 a month, principal and interest. And then the sale price is usually in the 70s or 80s.
So you're getting somewhere around $30,000 to $40,000 of note equity per deal.
Yeah.
What's the reason you're using a JV partner? What is their role?
They're just helping bring in more capital and helping with accounting and marketing and everything. My goal is to start bringing in PML, which typically is a 5-year note at 12% fully amortized. So very little cash flow in the beginning. And then after 5 years, you've got this fully paid off house. The other notion I'm playing with is to have a private money partner where we would share in the cash flow. The PMP gets paid back, and then we adjust the cash flow splits. I take the majority position, but they still enjoy cash flow for another 5 years. The whole reason for doing that is to appeal to more lenders who want a better return. My goal is I'm seeking $300 per deal out of the gate. When I'm using a PML, it's only like $100 a month, and I'm trying to replace my W-2 right now.
For you, it's more important to get the cash flow now. The idea of the slow flip is that you're bringing a private money lender in for 5 years and they get most of the cash flow for 5 years. But after 5 years, you're going to start cash flowing $800, $900 a month. So it's a slow way to get to that cash flow for you. But typically when you do that, you're only going to have a remaining $100 a month in cash flow. And then usually they get like $5,000 up front for setting the deals up.
An extra 5,000. Yeah, I mean, it really just depends on what your purchase price is. Ideally, 30,000 is 667 a month for 5 years. So if you're borrowing 35, that's going to up your note payment to the private lender and therefore lower your cash flow. So it really just kind of depends on what you need. I think it's smart to borrow more than 5,000. You have to prepay a year of insurance. You might have to do a clean out like I talked about. You might have to carry it for 2 or 3 months until you can get a tenant buyer in place. It's good to have an acquisition fee too.
What kind of down payment are you normally getting from your buyers?
About 2 to 3,000.
So it's pretty low. How often are you churning through these tenants?
I haven't had any turnover yet, but I'm still fairly new, but it's pretty common. There's not a whole lot of underwriting that's going into it because you're not underwriting like the traditional note mortgage. I'm doing income verification and background and criminal checks, but people are struggling and prices are going up. So I think that default is going to become more common.
I was told that usually takes about 3 go-throughs before you find your forever buyer.
That's where I want to get to. Obviously, it's less a headache for me, and I'm trying to create homeowners out of this, but there's also a desire to get things filled fairly quickly.
For sure.
And
Whenever we have a vacant house.
Vacant house is dangerous, and marketing is really critical. And we all default to Facebook. I saw your thing that you put out on Craigslist. I'd love to hear more about that. Also, just listing, you can sell it on the MLS as a seller finance.
Gotcha. It sounds like the biggest challenges is mostly in like raising the private capital. And then when you do raise that private capital, if you do it without the JV structure, you're oftentimes not really cash flowing anything for the first 5 years. I'm surprised that it's only selling for 70,000 for a $30,000 house. I think that would sell for closer to 90.
Yeah, it depends. The equation is determining what the market rent is, subtracting taxes and insurance, and then that's your payment, right? And then trying to make something that isn't too high where it becomes off-putting to a buyer when they see that all the houses around there have sold for 20 or 30,000. And that's kind of a moral quandary that I've had, but the service that we offer, financing to people, true qualification and credit check is worth quite a lot.
I just broke this down I did an underwriting call on Wednesday and I just broke down, like, I was looking at our old wholesale deals and there was one that we got for 25,000. And I was like, we could have sold this as a slow flip for 90. And
Yeah.
like the ARV is probably 160. It probably need like 50,000 worth of work. These families, when they fix up the properties, they're doing the work themselves. The service we're providing is that they can't buy a house otherwise. So they're gaining access to homeownership. They'll do work for equity and fix up the properties themselves. And then they're going to be locked in with $1,000 per month PITI for 30 years, right? So if you look at it over a time horizon, they're going to capitalize on all the appreciation. They're getting the debt pay down as well. So there is a huge service happening there because they're building generational wealth through your product, and they couldn't buy a house otherwise.
Yeah, absolutely. I mean, it's definitely a necessary service. Someone in our group was recently posting saying, "Do you think there's an issue of oversaturation in any one market for tenant buyers?" And I feel like there's such a large group of people who have decent income but can't qualify for one reason or another. So I think you're never going to run out of buyers. It's more just finding the right house for them.
For sure. What's your goal for the next year, like with this model?
My goal by the end of 25 was to have 25 homes for an actual calendar year. I'd love to get to 50. I start with the monthly cash flow number, which is 15,000 for me. If I can get to 15,000 a month in cash flow from these deals, if that's, 30 houses, if that's 50 houses, it just kind of depends on the private money.
Yeah. So you're thinking about $300 per month. What's your split with your JV partners look like?
So far, we've each put in the same amount of money and the split will be the same. I might shift that if I find that I'm doing more of the work than they are. To actually qualify as a JV, both parties need to be doing something. And that's one thing I'm trying to figure out. If I bring on private money as a partnership, do I need to form an entity with each one of those partners? Can a JV suffice? Trying to just find out the right terms of agreement to make that work.
What have you thought about so far for that?
I think forming an entity will help alleviate some of the gray area. I have heard that JV agreements just don't stand up as well. You could have a perfectly fine agreement and then people's individual circumstances change in a year and they want to change the terms. And so I think doing it as an entity with a proper operating agreement makes the most sense. A lot of folks in the slow flip group buy in land trusts and then sell the beneficial interest in the land trust, which is a way to create some anonymity and asset protection. I do think it's probably for most tenant buyers a little hard to understand that notion. So I have to figure out how to educate my buyers on that.
Yeah, that's the thing you get with trust. Trust had a lot more complexity and a lot more explanations happening as well.
People are already skeptical of this. They think it's a scam because you're offering them a house for $3,000 down, basically. There is a certain amount of education that has to happen there. So one thing I want to do is start building a Facebook page for marketing for buyers and start with the buyers list first and start cultivating good buyers and then go find homes that work for them that way. I think people do that with wholesalers. So I think it makes a lot of sense this way as well.
What do you feel are the biggest challenges with the model so far?
Trying to determine what market to focus on and trying to understand if I live in Knoxville, so I've looked at Memphis, I've looked at Birmingham, looked at Jackson, Mississippi, and there's a lot of homes that are cheap, but you don't know if those are environments that are frankly safe to invest in. It's just trying to figure out where I want to locate economically consistent, stable jobs, things like that.
Yeah, whether it's like small towns or cities. If you're doing it in a city, it's going to be in like a pretty rough area if you're getting $30,000 houses.
Yeah, exactly. So the homes in Flint, Michigan have been nice. I've done 4 there. Flint obviously had the water issue, which I think they've invested a lot of money to remedy. I've got one right now that I'm trying to sell outside of Greensboro, North Carolina, which is a great market. Reidsville is this small town. It's part of the MSA of Greensboro, and the ARV is about 120, 130, and we got it for 40. So it should sell. It's just a matter of finding that right tenant buyer. So most challenging things, I think, money, focusing on what market I want to be on, and really just creating systems around advertising for buyers.
Yeah, because a lot of our buyers are Latina, like a lot of the families that we end up seller financing. But I think this flip's a little bit different.
I think that would be a good market as well. Things are a little challenging for the Latino communities right now.
For sure.
So, and that, again, that depends what city and what part of the country you're talking about.
Awesome, man. Well, that's awesome. The success that you've had. Really like this model. And I still the power of seller financing in general. It's just like when you start seeing the because you've done it with mobile home parks also, or mobile homes. And I
Yeah.
also see people doing it with mobile homes, doing it with houses. It's just like there's so much there. I want to open it up and see if anyone has any questions or any clarifications. So if anyone has any questions, hop on.
Hi.
I have one. Have you ever considered doing sub two and then doing financing on a sub two acquired property?
Absolutely. I was just looking at one recently that was in Atlanta, and it was 250 for all the comps were 300. The note was 250. The entry fee was crazy. It was like 17,000. The sub two note was like 13, 1400, and taxes was like 400. And then there was an HOA of 100. So having a monthly payment that was already at 2,000, I was worried that I was getting into that zone where it was going to be hard to find tenant buyers at 24, 2,500. Certainly for something lower, I would look at sub two deals and either do a contract for deed or a traditional wraparound with a properly underwritten seller finance note.
Yeah. And Ty, we've done a lot of sub two wraps. Like that's more an area where we've done a good amount of that. And it's all based off the numbers in the entry fee because it's all an equation. We also go for the affordability. Our properties, we know our sweet spots between 1,500 and 2,000 for the PITI that we can sell for. We can also sell up to 2,500. Freddie's doing more expensive houses around the country, but we like to be in that affordable housing range as well. And so if the PITI underlying on a seller on a sub two is 1,000 to 1,500, we know that will work in the Midwest.
Mm-hmm. Yeah, I've done a couple wraps as a private money partner, and those have been great because I put up the entry fee. We got the entry fee back on the down payment, and now it's just pure cash flow for over a year now. Seller financing, when done right, is incredibly powerful, and I'm just trying to get better at it.
The more I look at all these strategies, every single one has some pros and cons. Like there's always gonna be challenges no matter what you do in business and what you do in real estate. It's just choosing your battle on which one you really enjoy. I love the idea of the slow flip, but you're also sacrificing a lot of the cash flow for the first 5 years, right? Where if you do a sub two wrap, you can start cash flowing $700 a month immediately and then not have that need to pay out the private lender first.
Right.
Or you can do a sub two wrap very similar to doing a slow flip where you put a private money partner, a private money lender on for 5 years, fully amortized to pay for that entry fee. And I have a very similar thing as a slow flip. You know, there's all these different pieces to put it together. And it's just really interesting to see how you can do it. And all the challenges. We like working with a lot of the Latino demographic because they're amazing tenants. A lot of our houses aren't in $30,000 house areas. There's just getting things stolen and things broken into. That would give me a little bit of intimidation with the slow flip model.
Yeah, and that's definitely something that I'm trying to wrap my head around and figure out the best way around it.
I have a vacant house. I have a handful of vacant houses, but one I just bought myself is in Kansas City. It's in a decent area. If I had to put a lockbox on it, the AC was stolen before I bought it. That's part of the motivation factor. And so, I'm being careful to not sure that it's vacant and make sure the lawn's being mowed and it's being taken care of. But it's definitely on my mind. When houses are vacant, these things just play in your mind. I'm also virtual right now, so I'm not in that area. So you don't want anyone to break into your house and start squatting because now you have an expensive problem.
Absolutely. Absolutely. And what something was interesting, they told me it's like you got to put a no trespassing sign on because if they squat when there's a sign on, then they're actually trespassing. But if there's not a sign, then I was like, I don't believe that. But nevertheless, we put the signs in just to be a deterrent. I think that still kind of figuring it out, but wanted to get into this and try it with my own money first. So I put my IRA funds in and I've used my IRA to be a private lender. That's gone well and sometimes not so well. When I put my own funds in, the return is 20, 30% annualized. So to me, that was definitely worth committing.
The more you do these, the more you find your process. And when you find your process, you can start doing it repeatedly.
I feel like I'm just putting in the 10,000 hours. I've been investing for 2 years and 4 months now, and it's definitely been a bumpy road. I don't know that I've arrived anywhere, but I've certainly gained a lot of hard-won knowledge.
When you start building residual cash flow, things feel a lot different. When you have $1,000 a month coming in, 2,000 a month coming in, and you just know that's going to come in no matter what, it feels great.
And then that was really what I realized was chasing these high return, short term deals that were much riskier. It only takes one foreclosure and getting wiped out to make you realize maybe second position loans without cross collateral don't make a whole lot of sense.
For sure.
And so, it's just been a really interesting learning curve there.
Yeah, definitely. Freddie, do you have any thoughts or questions?
Just listening pretty
Nice.
well. I'm pretty familiar with the model.
You
Yeah.
said you're buying virtually all over. Is that or you're wholesaling or what are you doing?
I actually am buying virtually pretty much throughout the Midwest and the Southeast. I'm in Florida. I learned a good amount from Scott, so I've implemented some of his stuff and what I do as well.
I'd love to connect and look at any deals that you're trying to move.
I personally do a lot of stuff in trust. Everything I do is in a trust with the beneficial interest. I find it's a lot easier and cleaner that way.
Now, do you have for the trustee, are you using a third party trustee or another entity?
I'm using a third party.
Is that just someone that's
It's actually what they do. He does that for a good amount of investors. When things go sideways, he'll go to court, he'll do whatever needs to be done. It makes things a lot easier.
and you're just a beneficiary?
That's all I am.
Cash checks.
Yeah, and then we've got the servicing company that's involved as well, and they're the ones that take the money and pay and do everything else.
Who do you like for servicing?
They're Alkali or something like that.
For the slow flip stuff, I've started using Baselane, which is like property management software.
Okay. Greg, tell me about your servicing process. Once you have the notes set up, who are you using and what does that look like?
For the 2 mobile home deals that I did, I use Madison because I've used them on my wrap deals and they've been pretty good.
Mhm.
The people in Slow Flip Group use either like Buildium or Baselane, which are property management tools that can invoice and send late notices. Those are just as good as a servicer, but it won't keep track of people make overpayments and your note equity and everything. So you'd have to track the loan separately. And then I know some people use FCI, Allied.
Okay, nice.
And you build the servicing fee into your payment? Like, do you build that back? Or you just
Yeah, we do an escrow cushion. So that within the escrow cushion, we include the note servicing fee. So we'll add in that. I think it's like $30 a month for Madison. We'll add that in. And then they're responsible for that plus tax insurance increases.
Yeah. Insurance is challenging. Like I was looking at some stuff in Ohio and it was, 1910 or an 1880s home. Definitely makes insurance trickier. No knob and tube wiring.
Interesting. What have you faced with insurance? When you're buying these properties, it's a different mindset. If you're doing knob and tube, you have to replace that, right? But if you're buying a slow flip, you don't necessarily have to replace that. Are you getting issues with insurance for that?
I haven't yet bought any that were that old, but I was speaking with the insurance broker I'm using. They had said to look out for that. And I think it was earlier than 1940 was going to be more of a challenge. I did have one recently canceled because there was too much renovation needed. So I just have to go with a different carrier. You got to have it insured as soon as possible. I pay for the insurance and then I'll bill that back and also request that the tenant buyer carry renter's insurance. Because it doesn't cover, my policy doesn't cover their possessions.
Okay. And the renter's insurance suggests if they get things stolen or the house gets robbed.
Exactly. Yeah.
Okay.
Or damage to personal property within the home.
I imagine insurance, there's so many insurance providers. So even if it doesn't work for one, I'm sure you can find another one that does work for you.
Yeah.
You literally just go online, you have your own portal, and you can add as many properties as you want. And then you pretty much just kind of give them the boilerplate policies, how you like to have them, the non-owner occupying policies.
Nice. I love to hear the progress that you made. It's really great to understand the inner workings of what you're looking for in these deals. I think the slow flip is super interesting. I think renovating mobile homes and selling them with seller financing is also really interesting. Anything that creates like this is the way to like be a lien lord and create passive cash flow. Congrats on the successes and thanks for coming on and sharing some information with us. It's cool to have people that you come on so we ask questions and learn from each other. And if people want to get a hold of you, where can they find you?
It's Gregory Crane on Facebook, Gregoire Crane on Instagram. It's my French name from French class. And my website is highergroundinvest.co, highergroundinvest.co. And I have, you can submit as a lender if you're looking for deals. I'm also a licensed loan officer, so try and wear a few different hats. Definitely DM me. I'm going to start doing the weekly Zoom to talk about the deals I'm doing and answer questions. Congrats on the community you built, man. It's really inspiring. And I've been watching and cheering from the sidelines.
We first started talking when we were they're raising capital. And when I first started raising a bunch of capital, I know we got connected and we just kind of been in touch ever since. I've been watching, seeing what you've been up to as well. And it's really good to see that you found a good lane. So I think a huge thing for everyone is just finding your lane. It's just choosing one thing and doing it. They all work. There's going to be challenges. There's going to be things that come up that we have to figure out with every exit strategy. But it's just finding one, doing it over and over again. And like my whole thing with our community is getting people to their first 10 to 15,000 in residual cash flow. Most people want to do 1 to 3 properties per month. That's what we're really honed in on, getting those repeatable processes in place so we can do this consistently.
Awesome. That's a great goal. Cool.
All right.
Nice to meet y'all. Feel free to reach out.
Thanks everyone for hopping on, and talk to y'all soon.